Boys and gals, welcome back to the channel. We have another jam-packed video to get into here today. You had initial jobless claims, which initially sent the markets down about 1%. You did get a brief recovery intraday, and then you did sell off towards the end of the day in anticipation of Netflix earnings. Now, Netflix earnings did come out really good. You gotta give it up for Netflix. They added over 7 million new paid subscribers when they were only forecasting, or the average analyst was only forecasting a little over 4 million. So they did massively beat expectations. The stock is up a little bit in after hours, and we'll talk about it, but a lot of other things are also happening at the same time. You had the vice chair to Fed Jerome Powell, Lael Brainerd, come out and reiterate the same thing that other Fed members have been saying, that rates will stay higher for longer. On top of that, you are getting some interesting upgrades out of Tesla, from analysts on Tesla stock. And it's very compelling, guys. So we're going to get into everything you need to know, technicals, data, all of that good stuff. The only thing I ask you to do is hit that like button and subscribe to the channel if you learn anything in this video. So let's get into it, guys. First things first, with the initial jobless claims. Now, initial jobless claims, we'll go ahead and update the trading economics calendar. By the way, if you guys do not use this, highly recommend that you use this, because you'll get all the information that you need to know, things that will move the markets. Now, we were expecting, we were expecting 207,000 initial jobless claims for the week of January 14th. You did get 190,000 initial jobless claims. So we're not seeing the labor market weakening at all. In fact, it might just be strengthening at this point, with unemployment still at 3.5%. I still can't even believe the last payroll report we got. The unemployment rate went from 3.7% to 3.5%. Absolutely crazy. The labor market is still not softening, and that's a problem for the Fed, but it's only a problem for the Fed if inflation does not continue to go down. The theory is if the labor market remains tight, then inflation will also remain very stubborn. And from what we're getting right now, labor market is remaining very tight, and this did send the markets down about 1%, give or take, right? It was a pretty volatile day, up and down, in between 0.5% and 1%. You did close down about 0.70%, and now you are up about 0.2% in after hours following these results out of Netflix. Now, before we get too far into that, let's get into what Fed Governor Lael Brainerd said about inflation, about Fed policy. So she sees, quote, high rates ahead even with progress on inflation. Brainerd insisted that the Fed won't waver in its commitment to taming prices that have come down some in recent months but remain near 4-decade highs. Markets are assigning a near 100% probability that the FOMC will raise its benchmark interest rate another 0.25 percentage point on February 1st. Quote, we are determined to stay the course, Brainerd said, using a phrase other Fed officials have echoed recently. And this is like a big game of chicken with the bond market and the stock market and the Federal Reserve. And why I say that is because the rate, the federal funds rate, is almost at 5%, right? It's what is it, 4.5%, 4.25%, whereas the 10-year Treasury is 3.39%. This is not markets being in line with what the Fed is doing, especially when the markets are thinking the Fed is going to cut rates in 2023, and every single Fed member has said that is not going to happen. You have not seen one of them say, yeah, we might have to cut rates in 2023. Why are they not saying that? Well, you have never seen a Fed pivot. You have never seen the Fed cut rates with the VIX under 40. It has never happened before. Never, ever in the history of the Fed, or at least going back ever since the VIX was created. Where is the VIX at right now? 20. It's at the lowest levels that you've seen throughout 2022, meaning there really is no fear in the stock market. People are talking up a a big game how the first half of the year is going to be bad and earnings are going to suck, but they're not positioned for it. The VIX is at its lowest levels you've seen in 2022. You're not going to get a Fed pivot until the markets crash, until stability becomes a more outweighing factor of inflation. Think about it like this. If, as the Fed, your dual mandate is price stability and 2% inflation, well, there's also a hidden mandate of, keeping the markets alive, right? The Fed has had a precedent of bailing out the markets ever since Black Monday in 1987. If the stock market really goes through another COVID-style liquidation, a just massive crash, where you see the VIX spike to 50 or 60, potentially, right? 40 being that baseline where we have to get to see the Fed actually cut rates, they're not going to cut rates unless the markets are unstable, unless there is question from global investors if American markets are solvent. That's where the Fed will start to accommodate the markets. They never have once cut rates without the markets crashing. Think about it. In history, literally, you can go back to any other time in history. You can pull up the federal funds rate right now. It'll take about 2 seconds to do so right here. Okay, I don't know what's going on there. Quick Google search ain't so quick, huh? Fed funds rate. Let's go ahead and pull it up. Over the last 20, 30 years, this is the federal funds rate. This is, so essentially when they cut rates is when this line falls. Just to make it very simple. 2000s, I mean, they were raising rates in 1999 until the 2000s pretty aggressively, from about 4.76% to 6.5% in the course of about 1 year. And then what? Shit hit the fan in technology, in the global economy. You go through a recession and the Fed massively cuts rates to about 1%. Same thing back here. From 04 until 2007, they were raising rates. What happens? The global financial crisis, lack of a better word, shit hit the fan. The Fed cuts rates. What happened back here? 2015 all the way until 2019, they raised rates very, very slowly. Did they raise rates? But then what happened? COVID came along, or at least the yield curve inversion came along out of nowhere. In August of 2019, they cut rates for the first time, and then they subsequently cut them to zero because of the pandemic. Now we're on this steep course to the upside with the federal funds rate, and they're not going to cut rates until you go through another crisis, until you see the markets come down in a massive way. So you got to be a little concerned about what is going on with the bond market and with the stock market. Stock market, for one, is not pricing in a recession. They're not pricing in earnings coming down. They are pricing in Fed rate cuts and accommodation in 2023. And you historically have never seen that happen. So all I'm going to say is be a little bit careful of what you are seeing in the equity markets to date. Now, like I said, you did get Netflix earnings. That is a very encouraging sign. But next week, you're going to get Tesla and you're going to get Microsoft. Tesla is on Wednesday. Microsoft is on Thursday. Those are going to be the big earnings for next week. And then the week after that, you're going to get your Apples. You're going to get your Googles. You're going to get the other high-flying technology stocks that the markets care about. That is what is going to really dictate the next 3 months, because I don't see, for again, a lack of a better word, shit hitting the fan unless it's earnings, right? If the markets have this 5% EPS growth for 2023 target in mind, and earnings start to decline like 5 or 10%, that's a big problem. That could cause a, shit show. That could cause the markets to come down in a massive way. That's what potentially could give you a Fed pivot, because at the same time, if the Fed pivots right now, inflation is on such a steady, move down that at one point, if the markets do crash, then you have a greater problem on your hands. Not necessarily inflation, but it could turn to the markets are a bigger problem. That it's worth sacrificing, potentially inflation goes up a little bit, to bail out the markets, to make sure markets are running efficiently. So take that as you please. Now, let's talk about this Tesla situation, guys. So, Tesla today did see a price target downgrade, but it was reiterated as a buy. And this is from Piper Sandler's analyst Alexander Potter. Cut his price target on Tesla to $300 from $340, but kept a buy rating. One reason is he is still positive on shares is that with lower prices, Tesla can grow delivery volumes greater than 50% in 2023. So he thinks greater than 50% growth for 2023. That is the whole premise of Tesla. If Tesla can grow deliveries by 50%, the stock is undervalued from where it's currently at. Price cuts or not does not matter. That's the simple factor that does matter. 50% or not, 40% or not. Anything under 40%, the stock, it might be a little expensive right now. 50%, oh, that's a bargain, baby. You want to scoop up as many shares as you possibly can. Now, if you just also type in Tesla stock news, right? Because just type in Tesla stock news. You could see from this investor, Piper Sandler, also says investors should be proactively buying at this point. He says Tesla took longer than expected to cut prices, but now that pricing adjustments have been made and now the valuation has reset, we think investors should be proactively buying Tesla. And this is actually from the same guy that put out the note that lowered the price target but reiterated his buy holding. It says Tesla shares have fallen more than 40% over the last 3 months since CEO Elon Musk bought Twitter. Many Wall Street analysts likened the stock's decline to a Twitter overhang, though the company had other fundamental issues arise, including a fourth quarter vehicle deliveries miss. The electric vehicle maker has since responded with price cuts in major markets such as China, Europe, and the US. It also slashed prices by as much as 20% with its most recent cut on January 13th. It goes on to say that the more affordable pricing could increase demand, according to Piper Sandler, which currently has an overweight rating and a $300 price target on the stock. The firm noted Tesla can now easily achieve at least 50% delivery growth in 2023. Quote, "We don't think most investors appreciate the extent to which lower pricing could support Tesla's market share," Potter wrote. "This is particularly true in the United States, where lower prices combined with a $7,500 tax credit could unlock at least 300,000 units of incremental demand, if not twice that." Boom, baby. Additionally, he added that price cuts could help Tesla poach demand from competitors like GM, Ford, and Ram, all of which have chipped away at Tesla's EV market share in recent years. The U.S. auto market has ample real estate for Tesla to exploit, the note stated. Tesla cutting prices has still raised concerns surrounding the company's margins. Wall Street analysts, including Potter, have cut gross margin expectations to adjust for Tesla making less money per sale on its vehicles. Still, Potter argued lower margins might not be as bad as feared for the automaker. Quote, "We are hopeful that such drastic declines may not materialize due to deflating raw material costs and better margins in Tesla Energy," he wrote. Even more importantly, we suspect that the margin profile of new capacity in Shanghai, Austin, and Berlin is higher than many expect. Tesla is expected to report 2022 Q4 earnings after the closing bell on January 25th, baby. If you have, man, that is so bullish. That's basically what we've been saying this whole time in a nutshell from someone else's mouth. These price cuts are a huge reason to be bullish. GM, Ford, these other companies, they cannot cut their prices on EV vehicles the same way Tesla can, and Tesla also with the $7,500 tax credit, I'm sure it makes all of you guys want to go out and buy a Tesla. And if you have the opportunity, I'm sure, at least if you're watching this video and you know about the $7,500 tax credit, you know that prices have just been cut, you're probably gonna buy a Tesla. That makes me insanely bullish. And you're also seeing, over in China, since the price cuts have actually been initiated, vehicle registration has went up like 75% year over year for Teslas for this same time period this year to last year, it's went up 75%. Bullish, baby. Very, very bullish on that one. Now, let's switch a little bit to the S&P 500. Like I said yesterday, you got rejected at this major downtrending line. That's about $400 per share. You got rejected, fell under the 200-day moving average, found some support at the 50-day moving average, and then today, you fell under that 50-day moving average. You fell to the low of the day, and then you did recover intraday, but you still got rejected again at that 50-day moving average. So it looks like the next stop is 384. That's going to be the 100-day moving average. Under that, you got to watch out for 375. But a little bit of a bright spot here is that Netflix just had good earnings. Tomorrow's Friday. Next week, you're probably going to get good earnings out of Tesla. Probably going to get decent earnings out of Microsoft. The ones you really got to be concerned about are Google, Amazon, and Apple, in my personal opinion. Now, Microsoft has been cutting employment. They have been laying people off, so that's somewhat not an encouraging sign. We'll see what happens with Microsoft, but they do have a stickier business model, so you might see some decent earnings next week as well. But the expectations are so high. So at one point, they're just high. They're high, they're high, they're high, they're high. Quite literally and non-literally, they're very high. So that's a big problem that I see in this market. If you can't tell, earnings, fundamentals, totally disconnected. Multiples, disconnected. Analysts, disconnected. So if we get through earnings season and things hold up in the markets, then that could be a turning point for 2023. And I think with Tesla stock, I mean, you are at a 2-year support level still. You've rallied a little bit, but you're still down at this almost 2-year support level. Even since December of 2022, you have went down. Let's see, just from this price that we're currently at, you are still down. Let's get December 1st. From the peak of December 1st, you're down 54.8% just from the peak of Jan 1st of 2022. That's a lot. Just to, recover some of that could easily push you over 150, even close to 200 per share would be fair. Would be fair in my personal opinion, and I think earnings could be a big catalyst to do just that, guys. So that is it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Most importantly, enjoy the rest of your day, and I will see you in the next one.